The government is quietly taking a cut of everything you build, and most people have no idea it's happening. Taxation isn't just a line on your pay stub. It's a slow, invisible erosion of every dollar you try to turn into something meaningful. Think of it like a leaky bucket. Every time money moves, when you earn it, invest it, sell something, or pass it on, the government punches another hole, and wealth drips out before it ever has a chance to compound. Now here's where it gets interesting, because the ultra-wealthy figured out a workaround decades ago, and they've been using it right out in the open. The secret isn't earning more, it's structuring how you access your wealth so the tax code barely touches it. The move is simple, in theory. Get into assets you can borrow against. Because here's the thing, most people sleep on, borrowed money is not taxable income. When a bank hands you a check, the IRS doesn't show up at your door because a loan isn't a gain, it's a liability. You haven't realized anything, which means you've accessed real purchasing power without triggering a single taxable event. Real estate is the most accessible, most battle-tested version of this strategy for everyday people. You don't need a team of accountants or family office to start playing this game. You just need to understand the rules. This is where the phrase buy, borrow, die comes in. And yes, it sounds morbid, but it's one of the most elegant wealth structures ever built inside the tax code. You buy a property, it appreciates. You borrow against that equity through a cash-out refinance or a line of credit, and you use those borrowed funds to fund your life or stack more assets, all without selling, all without triggering capital gains. Now, some people hear this and immediately think it sounds too good, too loopholey, too Wall Street. But this isn't a glitch. It's literally how the system was designed, and the only people not using it are the ones who were never taught it existed. Here's the part that really makes your brain light up. When you pass away and leave that property to your heirs, it receives what's called a step-up in basis. That means the property's cost basis resets to its current market value at the time of death, which can wipe out decades of embedded capital gains in a single legal moment. So your heirs could sell that property and owe little to nothing in taxes on appreciation that took 30 or 40 years to build. That is generational wealth, not just leaving something behind, but leaving it in a form that survives the tax code intact. The lesson history keeps teaching us is that assets beat income every single time when it comes to long-term wealth building. Income gets taxed when you earn it, taxed again when you save it wrong, and taxed a third time when you pass it on. Assets held correctly can sidestep all three of those hits. You don't need to be reckless or over-leveraged to play this game. Discipline and patience are the actual strategy. Start with one property, understand your numbers, borrow conservatively, and let time and appreciation do the heavy lifting while the tax code works in your favor. The philosophical truth underneath all of this is that wealth isn't about how much you make, it's about how much you keep, how long you hold it, and how cleanly you pass it on. Discipline, positioning, and consistency are the actual currency of generational wealth. And honestly, the most empowering part of knowing this is that you can move forward with clarity regardless of market conditions, because the structure works in good markets and bad ones. Rational preparation beats emotional reaction every single time, and the people who win long-term are the ones who built a system and trusted the process. If you're ready to start building that system, whether it's getting into real estate investing, finding the right contractors for your properties, or connecting with lenders who understand the strategy, check out our links in the description below.